In Chapter 9, I'll be going through some of the more common tax credits that are available to taxpayers. One is the child and dependent care expense. This is to assist working families who have child care expenses, for example, or other dependent care expenses. And the amount of the expenses that qualify depend upon the adjusted gross income, and I'll demonstrate that shortly. And the amount of expenses that couldn't qualify are limited to $3,000 for one qualifying child and double that, or $6,000 for two or more qualifying children or individuals. The expense is also limited by the fact that if a taxpayer is not working or has a lesser income, then the amount of the expenses is limited to the lesser earning spouse. And so it's presumed then that if a spouse is not working full-time or has lower income, they're better able to or positioned to take care of the children at home. In the case of a non-working spouse, the spouse is treated as having earned $250 per month for one qualifying person and $500 for two or more qualifying children. In the case of one of the spouses who is not working full-time, for example, attending school, only the months he or she is attending school may be used. So let's demonstrate that calculation briefly here. This one question is at the end of the chapter, relates to chapter question number 23 on page 944. Well, we have Jameson as a single dad with two dependents, so that means the maximum expenses that would qualify would be $6,000. Adjusted gross income, which we'll need to know, is $69,000. The actual out-of-pocket expenses for Jameson, the child care expenses, is $4,300. So if you look at the table on page 9-4, based on the AGI, the applicable percentage that we would apply is 20%. So we will first of all take the minimum of the actual out-of-pocket of $4,300 or the $6,000, and of course $4,300 is less, and we'll multiply that by the 20%. So the $4,300 times the 20%, that gives us $860. So that's the general calculation then for the child and dependent care expense credit. There is also another credit for elderly or disabled. And the elderly or disabled credit is designed, just as the name or title implies, that it's designed to assist those who are elderly or those who are unable to fully provide for themselves or adequately provide for themselves. And so there's a $5,000 limit for single taxpayers, $7,500 for joint returns when both spouses qualify, and $3,750 for married filing separately. The bases these bases listed up here can be further reduced by the amount of any non-taxable Social Security benefits that are received, 1/2 of the amount of AGI that exceeds the base amount, which is $7,500 for single, $10,000 for joint, and $5,000 for married filing separately. So again, instead of just explaining this credit, it's better to kind of demonstrate it. So we'll go back to our Excel spreadsheet here. This question is also at the end of the chapter, relates to question number 25 on page 945. And here we have a couple both over 65 filing a joint return, AGI of $18,000. They did receive $1,000 of non-taxable Social Security benefits. How much of this elderly or disabled credit do they qualify for? So I just entered the data in the tan cells as I do. And the $18,000 of income received, AGI. And we have $1,000 of the non-taxable Social Security benefits. The maximum allowable credit is 15% of the reduced or recalculated amount. So we have a base amount for these taxpayers of $7,500. The reduction amount then is going to be the extent to which this $18,000 exceeds $10,000. And again, that's a table is listed in the chapter that shows these tiers. I also presented them a few minutes ago in the PowerPoint. So we'll take half of 18,000 over 10,000, and that'll be a reduction of the amount of our base, as well as the $1,000 will be having to reduce. So the amount of the base by. So we have, in a sense, our reduction amount, and I listed these separately. The reduction of the base amount is going to be 1,000 plus half of the extent to which 18,000 exceeds 10,000. And so our reduction amount is $5,000. So their base amount was $7,500. We're going to reduce that by $5,000 as I outlined here. And I also have this calculation described in a note. And then the final calculation is the amount of the credit. And the amount of the credit then will be $7,500 minus $5,000 times the 15%. And that is the amount of the credit for the elderly in this case. Moving on to education credits, there are two full education credits: American Opportunity Tax Credit, also known as the Hope Scholarship Credit, and then the Lifetime Learning Credit. And we'll demonstrate a few of these two credits. First of all, let's discuss a little bit the AOTC, American Opportunity Tax Credit. Is 100% of the first $2,000 of qualifying expenses, usually meant for tuition and fees, 25% of the next $2,000 with a maximum of $2,500, and this is an important part as well, per student per year. Per student per year. And that means if you have a couple children in college, then each of them would qualify for the $2,500 maximum credit. Lifetime Learning Credit is a little different, and by the way, the AOTC is really meant for the first 4 years of college. Lifetime Learning Credit is less restrictive in the kind of education that qualifies. You don't need to be pursuing a degree, for example. It could be a graduate degree as well. But it's 20% of the qualifying expenses, such as tuition and fees, we said. But the maximum here is only $2,000, but this is per taxpayer. Single filers and married filing joint phase out completely when MAGI reaches $90,000 for single and $180,000 for married filing joint. So there's a range there. $10,000 range, $80,000 to $90,000 for single, and a $20,000 range, $160,000 to $180,000 for married filing joint. So let's demonstrate then this calculation of the education credit. So if we look on page 945, question number 28. In this problem, the taxpayers have an income of $170,000 for a joint return. So their AGI is $170,000. They would like to know what is the allowable American Opportunity Tax Credit based on their AGI amount. Well, I just listed, of course, the AGI amount, the amount of expenses in play, and the amount of the AOTC phase-out. And so what is the phase-out? Again, it's going to be based on their adjusted gross income. So in this case, the phase-out would be a minimum of the $2,000, which is $2,000 plus 25% of the extent to which $3,200 exceeds $2,000, or $2,500, because the maximum AOTC credit is $2,500. So the amount before the phase-out, this is the most of the credit that they qualify for. It has to be less than $2,500, we know that. And then, as I say, the calculation is pretty straightforward. It starts with $2,000, then you take 25% of the amount that's left, as long as it doesn't exceed $2,500 in total. So that's the amount that they could realize in a credit. However, their adjusted gross income is quite high. So it turns out my calculation is that they're going to have to reduce or phase out half of this $2,300 credit, because the upper range is $180,000. We multiply that by the $170,000, the actual AGI of the taxpayers, and then divide by that range I mentioned earlier of $20,000. And this formula, of course, is in the text as well as on the PowerPoint. All right, and so this is the amount we're going to phase out. We'll have to cut it in half, and that gives us $1,150. So the AOTC credit for these taxpayers, because of the high income phase out, is half of their full credit of $2,300, which is $1,150. In the next This video will be discussing more of the credits found in Chapter 9.